Hello, everyone. My name is Rebecca Kilpatrick, and I am presenting our topic today for fringe benefits, the proper taxation of them and other payments. So today we'll probably get through at least those fringe benefit rules. Stop me if you have any questions, but we'll get through as many as we can possibly get through today. Your fringe benefit rules. So you can take a look at this table. Down the left side of the table has anything that is taxable compensation for federal tax purposes. And the right side of your screen of your table there has the non-taxable items. Those are items you can pay to your employees or provide your employees with that do not have to be taxed federally. You always want to double check your state laws, but this is going to simply be on the federal overall. So with fringe benefit rules, employers must determine if benefits they provide their employees qualify as taxable income and are thus subject to federal income tax, Social Security, Medicare, and FUTA. Employers may treat these benefits as being paid on a pay period, quarterly, semi-annually, annually, or other basis, but no less frequently than annually. So if you have, certain items that you want to add to someone's income, you have to at least do that once a year. IRS requirements. The amount of any benefit an employer must include as income is the amount by which the fair market value of the benefit exceeds the amount the employee paid for the benefit, plus any amount the law specifically excludes. So your example is Harry's employer pays for Harry's parking space in a commercial parking lot next to the employer's premises. The employer's cost for the space is $320 per month. In 2020, which is the same fee charged to all monthly payers, Harry pays nothing for that parking space and has access to that lot every day. Up to $270 per month of that employer provided parking expense is excluded by income. In 2020, Harry's taxable income from the parking benefit is determined as follows. So the fair market value amount is $320. The amount excluded is going to be that $270, because $270 of that the government says you do not have to pay tax on. So the amount of income that you're going to tax Harry on for that parking space is $50 per month. I would somehow tag this particular topic in your notes. I was tested on this particular area several times. There were several questions on the CPP for parking and transportation expenses specifically. Non-cash benefits. Employers may use one of three methods to withhold federal income, Social Security, and Medicare taxes from non-cash benefits. You can add the fringe benefit amount to the employee's regular wages for a pay period and calculate the withholding on the total amount. The fringe benefit amount may be spread over several pay periods to lessen the tax impact rather than adding it all at once. Or two, you could treat the included fringe benefit amount as supplemental wages and withhold the federal income tax using that optional flat tax rate of 22%. Or if an employee's year-to-date supplemental wages exceed $1 million, the employer must use the mandatory flat rate of 37%. Estimated tax payments are included on quarterly forms 941 for the period in which the fringe benefit is considered paid. The actual cash value of these benefits must be reported no later than quarter 4 of that 941. Non-cash benefits special accounting rules. Employers can treat fringe benefits provided to employees during November and December of one year as being paid during that next year. The rule applies only to non-cash benefits. So just an item that you're providing that employee during November and December, employers must notify those employees of their decision to use the special accounting rule. Employers can choose to use the special accounting rule for some benefits and not others. But if the rule is used for one benefit, it must be used for all employees using that benefit. So continuity is important. Employers can use different ending dates during November and December for each benefit, which would also then change how those taxes are hitting everyone's check. Employers can use the special accounting rule on their personal tax returns only if their employers use it, and they must use the special rule if their employers use it. The special accounting rule may not be used if the non-cash fringe benefit is personal property normally held for investment or real property. The rule can also be used to value cash benefits such as taxable moving expense. In our example, Darla is provided a company vehicle which can be used for personal purposes. Using the special accounting rule, Darla's employer can value the personal use of that vehicle between November 1st, 2019 and October 31st, 2020, and include the value in income on Dana's 2020 Form W-2. Here's your first pop quiz. All of the following benefits are taxable fringe benefits except which one? A $15 gift card, an employer contribution to health plans, employer reimbursements for relocation related mileage, or company provided group term life insurance in excess of $50,000. Which do you think? Here's your answer. The only item in this list that is not taxable would be employer contributions to health plans. Under the IRS rules, employer contributions to a health plan are not taxable. Cash payments such as gift cards, group term life in excess of $50,000, and all reimbursements for relocation related moves are taxable. Pardon me. Non-cash benefits, Section 132. Section 132 exempts certain fringe benefits from inclusion in income once certain conditions are met. They are not subject to federal income tax or Social Security, Medicare, or FUTA taxes. These fringe benefits include no additional cost services, qualified employee discounts, working condition fringes, de minimis fringes, qualified transportation benefits, on-premises athletic facilities, or qualified retirement advice services. An employer may offer free services to its employees without including the fair market value of those services, the income in the employee's income, only if the following conditions are met. That free service is one that is regularly offered for sale to customers in the normal course of the employer. The employer bears no substantial additional cost, including lost revenue and additional labor, in providing that service to the employee. The term employee includes current and former employees who have left because of retirement or disability, and their widow or widowers, spouses, and dependent children. The service is available on equal terms to each member of a group of employees whose classification does not discriminate in favor of your highly compensated employees. Your example is John is a cashier for the out-of-town Inn Corp, which owns hotels around the United States. While on vacation, he and his wife and children stay for free at a company-operated hotel where there is space available. The free hotel rooms are a no additional cost service, even though he receives housekeeping services incidental to the room. An employer may offer discounted goods or services to its employees without adding to the fair market value of the discounts to the employee's income if the following conditions are met. The discount on goods cannot exceed the gross profit percentage when the goods are sold to customers. Your gross profit percentage would be your total sales or cost of goods sold over your total sales. The discount on services cannot exceed 20% of the price at which the services are offered to customers. The goods or services must be offered for sale to customers in the employer's line of business. The discount is available on equal terms to each member of a group of employees whose classification does not discriminate in favor of your highly compensated employees. Real estate, whether it's for investment purposes or not, does not qualify for the employee discount. Neither does personal property held for investment, such as stocks, bonds, and other securities. The term employee still must include current and former employees who left because of retirement or disability, and their widowers, spouses, and dependent children. So your non-cash benefits or de minimis fringe benefits, these are things that you can provide to your employees without including in their income to be taxed. As an employer may provide certain property or services of small value to employees without including the value in their income, or only if the following conditions are met. The value of the benefit is so small that accounting for it would be unreasonable or impracticable. The benefit should be offered on an occasional basis in order to qualify. You wouldn't want to have this be like an every Friday or once a month type thing. The term employee means anyone to whom the benefit is provided. Simple types of these de minimis fringes may include occasional printing of personal letters, occasional personal use of a copy machine, occasional parties or picnics for all employees, occasional tickets to sporting events or the theater, traditional holiday gifts of small value, coffee or donuts, occasional use of a company phone, occasional meals or supper money or cab fare for an employee who must work late, cab fare for an employee working other than their usual shift in unsafe circumstances, operation of an eating facility on or near the employer's premises if it does not operate at a loss, personal use of a company cell phone that's provided primarily for business purposes. Gift coupons or gift certificates must be included in income. So keep in mind, it's really not giving you a value here. It's saying those types of things must be included in income. An employer may offer certain work-related property or services to employees without including their fair market value in the employee's income if the following conditions are met. So these are going to be your working condition fringes. The employee's use of property or services must relate to the employer's trade or business. The employee would be able to take a business deduction on his or her personal tax return if the employee had paid for that benefit. The term employee, again, must include current employee, partner, director, or independent contractor performing those services for the employer. The employer must maintain the required records to substantiate the business deduction. Types of working condition fringes may include business use of a company car or airplane, chauffeur or bodyguard for security, professional dues and membership fees, employees' subscription to business periodicals, job-related education, goods used for product testing for employees, use of a demonstration automobile by a full-time car salesman, distinctively marked casual items of clothing used as uniforms to police officers and firefighters, outplacement services, business use of cell phones provided primarily for business purposes. Non-cash benefits, cell phones and things are considered working condition fringe benefits. Sorry, got tongue-tied. The guidance says that when an employer provides a cell phone to an employee primarily for non-compensatory business reasons, the IRS will treat the employee's business use of a cell phone as a working condition fringe benefit. Examples of substantial non-compensatory business reasons include employers need to contact the employee at all times for work-related emergencies, employers' requirement that the employee be available to speak with clients at times when the employee is away from the office, and employees need to speak with clients located in other time zones at times outside the employee's normal workday. A cell phone provided to promote the morale or goodwill of an employee, to attract a prospective employee, or as means of furnishing additional compensation to an employee is not provided primarily for non-compensatory business purposes, and the fair market value of that cell phone will be included in the employee's income. Qualified transportation fringe benefits. Again, just a little tip. This was on the CBP test when I took it many times. The employer may provide certain transportation fringe benefits to its employees without including the fair market value of their benefits in their income. They include transportation between home and work in a commuter highway vehicle provided by the employer, like a van pool type thing, only if the vehicle seats at least 6 adults other than the driver. At least 80% of the vehicle's mileage can be expected to be for commuting. At least 50% of the vehicle's seating capacity, excluding the driver, is used by employees. Transit passes, tokens, or fare cards, or reimbursement for them by the employer. And 3, parking provided on or near the employer's premises or at a park and ride facility. Employers cannot provide the benefit through cash advances without the benefit being taxable. However, employers can offer cash compensation instead of a qualified transportation fringe benefit, and the amount of cash offered will be included in the income only if the employee chooses cash instead of that transportation benefit. Example, Sherman Shoe Court offers all of its employees a choice between an $80 transit pass and $80 per month in additional compensation. Only those employees who choose the cash instead of the transit pass must have that $80 included in their income each month. Here's your other pop quiz. A qualified transportation fringe benefit allows employers to provide employees which of the following benefits on a tax-free basis: reimbursement for transit pass without substantiation of the cost of the transit pass, cash advances of $100 for subway passes that are not substantiated, transit passes for public buses not to exceed $270 per month, parking in a public lot that costs $320 per month. Again, which of those benefits could be provided tax-free? If you guessed transit passes for public buses not to exceed $270 per month, you're correct. The IRS rules allow employers to provide the qualified transportation fringe benefits, transit passes, commuting in a commuter highway vehicle, and parking when meeting certain requirements. Qualified transportation fringe benefits up to $270 per month are not taxable.
Was not a guess. I just knew that one.
And I was surprised because this particular question was worded in several different ways. And I know every CPP exam is a little different, but I had this item just worded in a few different ways. So they really want you to know how much is tax-free on transportation. Non-cash benefits for on-premises athletic facilities and qualified retirement advice. An employer may allow its employees to use on-premises gym or other athletic facility free of charge without including the fair market value of the use in the employee's income if the following conditions are met. The athletic facility is located on the employer's premises, whether leased or owned by the employer. The athletic facility is operated by the employer through its employees or another entity. Substantially all use of the athletic facility is by employees, their spouses, and dependent children. The term employee, of course, still includes current and former employees who left because of retirement or disability, as well as their widowers. The athletic facility is not a resort or other residential facility. Qualified retirement planning services provided to an employee and his or her spouse by an employer maintaining a qualified plan, 401k, 403b, those types of things, but not a 457, are excludable from income and wages. The exclusion does not apply with respect to highly compensated employees unless those services are available on substantially the same terms to other employees offered such services. Again, maintaining that you are not discriminating in favor of those highly compensated employees.
Right, and next week we're really going to dive into those qualified plans.
Right. More non-cash benefits for moving expenses. Employers often pay their employees moving expenses when they relocate to begin a new job. All amounts reimbursed must be included in income and are subject to federal income tax, withholding, and Social Security, Medicare, and FUTA tax. For a member of the armed services, if the move is due to a permanent change of station, the moving expenses incurred due to the move are not included in income and are not reported on Form W-2 boxes 1, 3, or 5. The amount paid directly to the employee excluded from income is reported on Form W-2 in box 12 with a code of P. Amounts reimbursed by an employer or paid to a third party are wages and must be included in box 1, 3, and 5 on a Form W-2. So if you're having employees, if you're hiring someone that's needing to relocate or you're paying someone to move, you definitely want to pay attention to how those moving expenses are to be noted.
How many questions are like you have to know the different codes? On the
I did not have any that I needed to know the specific code for the W-2. I don't know that that's going to be the case for all tests, but I was concerned about that and was pleasantly surprised.
I think I had a couple questions where it asked me, but it was the big ones like the healthcare code DD, the
Okay.
retirement plans. It's it's not like the real weird ones, but I would know the employer share of healthcare, the deferred compensation, group term life. Those are the ones that come to my head. I think I had one on retirement plan and maybe one on group term life when I took the test. So
I do know I had a lot of calculations for group term life, so we'll get into that later this week.
I think I had a couple calculations on group term life. I wouldn't say a ton, but I definitely had some. So
Nice. Employer provided benefits. Still, we're going into awards and prizes, income and exclusion. Awards and prizes provided to employees by employers are generally included in the employee's income and are subject to federal income tax withholding, Social Security, Medicare, and FUTA. There are exceptions for certain non-cash awards that comply with several restrictions. The length of service or safety achievement awards, tangible personal property. I did not happen to see in this to see if 2020, if that amount changed, but typically those length of service awards, Melissa, you can correct me if I'm wrong, but I believe it's anything over 400 is what you would have to then include in their income. Wasn't that the?
I can't remember because I took a previous year's test, so I think my limit may have been different, but yeah, 400 sounds correct.
I know I had that question, so I was surprised reviewing these slides that Patreon didn't review that amount with you. So you may be an item that you want to research on the side, just to make sure that you know what those 2020 amounts are for anything that can be excluded, especially for those length of service awards. Your civic and charitable awards or prizes for retail salespeople that are non-cash. Under the clarified definition, cash equivalent, gift cards, gift coupons, or gift certificates, other than those conferring only to the right to select or receive certain tangible personal property from a limited array of items pre-selected or pre-approved by the employer. So, if you give someone a list of, you won salesperson of the month, you get to choose A, B, or C type thing. Or vacations, meals, lodging, tickets to the theater, sporting events, stocks, bonds, other securities, and other similar items do not qualify as tangible personal property. Gifts provided to employees must be included in the employee's income and are subject to federal income tax withholding, Social Security, Medicare, and FUTA taxes unless they can be excluded as a de minimis fringe benefit. Pop quiz. An employer pays $268 per month for an employee's parking spot near the job site. Calculate the taxable amount of the monthly parking. If you guessed 0, you are correct. Under the IRS qualified transportation fringe benefit rules, the fair market value of a parking near the employer's job site or a park and ride in excess of the monthly exclusion, $270 in 2020, is a monthly taxable value. And I can tell you without a doubt. It was worded a little differently, but this was a question on the CPP in a couple different ways, but specifically to know if they're giving you the question to calculate the taxable value, and it was actually under what was allowed per month. So I found that to be interesting, that 0 was the actual correct answer. Personal use of company vehicles. When company-owned vehicles are used for business-related purposes, the value of the vehicle's use is excluded from the employee's income as a working condition fringe benefit. All other use of vehicles and personal use and is generally considered taxable income to employees. Here's your reasons: de minimis fringe benefit, qualified non-personal use of a vehicle, or automobile salespeople. If employees use company-owned vehicles for both business and personal use, the employees must account to their employers for the business use of the vehicle. This is done by substantiating the miles driven, the time and place of travel, the business purpose of the travel. Valuation methods of that would include the general valuation methods or special valuation methods for commuting valuation, annual lease valuation, vehicle cents per mile valuation. Withholding on company provided vehicles. Employers can make the choice to withhold federal income tax on the value of the employee's personal use of a company provided vehicle from some employees and not others. If employers elect to not withhold, they must still include the value of the employee's personal use of the car on the employee's Form W-2 in box 1, 3, and 5. The option to not withhold federal tax from the employee's personal use of a company car does not extend to the employee's portion of Social Security and Medicare. That piece is still required. The value of commuting. Here's your commuting method. $1.50 per one-way commute and $3 per round trip if the following conditions are met. The vehicle is owned and leased by the employer and is provided to the employee. The employer requires the employee to commute to and from the work in that vehicle. The employer has a written policy prohibiting the employee from using the vehicle for personal use other than commuting or de minimis personal errands, and the policy is enforced. The employee is not a control employee. Instead of using these definitions, the employer may choose to treat all its highly compensated employees as control employees for the purposes of using the commuting valuation method. Or the annual lease method. The fair market value of the employee's personal use of a company provided car is determined by multiplying the annual lease value, or ALV, of the car by the percentage of the personal miles driven. Find the fair market value on the IRS lease value table on the first day the vehicle is made available for personal use. Calculate the percentage of the personal miles driven per year. So your example, Gilbert drives an employee provided car that he uses for both business and personal driving. Gilbert drove 17,000 miles during the year, of which 12,300 were business miles and 4,700 were personal miles. The car's fair market value is $16,200. The amount of the car's fair market value that must be included in Gilbert's income for the year is calculated as follows. So you can see the annual lease value of 16,200. The percent of his personal miles is 4,700 divided by 17,000, the overall miles. The fair market value of personal use, your 4,600 miles, or $4,600, excuse me, I skipped that step. So your overall, I wanted to highlight that. Doggone it. Slide won't let me highlight it to point it out. Your overall fair market value of personal use is $1,271.90. You're going to take the percentage of those personal miles and then use that same percentage to calculate out the actual value of those miles driven. Gilbert's employer also provides all of the gasoline required for both business and personal use of the vehicle. Now you need to charge him for the gasoline as well. Those personal miles, you can charge him 0.55055 cents per mile. 4,700 miles that he drove for personal use times the 0.055 is $258.50. So that total income is going to be the value of the vehicle of $1,271.90 plus the gasoline miles of $258.50 total income that he will be charged federal income tax, withholding, Social Security, Medicare, FUTA is $1,530.40.
So he doesn't, in this example, owe that much back to the company. It's just that becomes part of his taxable wages.
That's his income. His income is now being increased by that amount.
Okay.
So no, you're correct. He does not get a bill saying pay this back to me.
But it will be in boxes 1, 3, and 5.
Correct.
Okay.
Or you can use the cents per mile method. Fair market value of the personal use of a company provided vehicle is determined by multiplying the IRS standard business mileage rate by the number of personal miles driven. The business standard mileage rate for 2020, and you will want to know this, is 0.575. Employers must expect the employees to regularly use the vehicle while conducting the employer's business, or the vehicle must actually be driven at least 10,000 miles annually, including their personal use, and be used primarily by employees. The fair market value of the vehicle placed in service in 2020 cannot exceed $50,400 for all vehicles, including fleet average sized values. That $50,400 is going to be important to know. If employees pay for fuel, the mileage rates are reduced by the 0.055 that we saw in our previous slide per mile for 2020. If the employer is paying for the gasoline, you'll use that full cents per mile rate for 2020. If the employee is providing their own gas, you're going to reduce it. Example, Margaret drives a qualifying vehicle 22,000 miles during 2020, including 9,400 personal miles. If Margaret's employer pays for the gasoline for the car, the fair market value of her personal use of the car is calculated as follows. Fair market value, 9,400 personal miles times 0.575 is $5,405. If Margaret pays for the gasoline herself, the fair market value calculation is the 9,400 miles times 0.575 less 0.055, or $4,888. Your key is going to be, doesn't matter what method you as a company decide to use. It just has to be the same for all employees who are driving a company vehicle. Pop quiz. An employee drove a company vehicle 5,000 miles for business and 6,000 miles for personal use. The car is valued at $53,650. Which of the following statements regarding the employee's use of the vehicle is true? The employer must calculate personal use of the vehicle using the cents per mile method. The employer must withhold federal income tax on the personal use of the vehicle. Of the safe harbor methods, the employer must use the annual lease method to report the value of the employee's personal use of the vehicle. Or the employee drove more personal mile than business miles and cannot claim the vehicle as a company vehicle. You can see the IRS rule is already on this slide, so you can tell the IRS rule, the value of the personal use of the company vehicle may be calculated using the annual lease value, commuting, or cents per mile methods. When using the cents per mile valuation method, the value of the vehicle cannot exceed the luxury vehicle value of $50,400 in 2020. It's the employer's option whether to withhold income tax. It does not matter if the employee drives more personal than business miles in the company vehicle when determining taxation of the personal use. So it's going to be option C. And we are 1 minute short, but we are ready to dive into group term life insurance tomorrow. Yay!
Thanks, Rebecca.
You are so welcome. Does anybody have any questions?
I kind of asked mine throughout, so thank you.
Sure.
Thank you.
No problem, Felicia.
All right. See everyone tomorrow.
All right. Thanks.
Bye.